Good evening. Now come to next exemption from applying equity method. When will a company not apply equity method? That is, it will not follow this standard IAS 28 for accounting for investment in associate and joint ventures. So next paragraph, exemption from applying equity method. An entity is exempt from applying the equity method if the investment meets one of the following conditions. The entity is a parent that is exempt from preparing CFS under IFRS 10, that is exempted from preparing under IFRS 10. Okay. Consolidated Financial Statement. So if you are exempted from preparing CFS under IFRS 10, then you are also exempted from applying equity method. Or if all of the following four conditions are met, in which case the entity need not apply the equity method. The entity is a wholly owned subsidiary or is a partially owned subsidiary of another entity, and its other owners, including those not entitled to vote, have been informed about and do not object to the investor not applying the equity method. So if it is a wholly owned subsidiary company, or if it is a partially owned subsidiary company and the other owners have been informed, means the NCI have been informed and they have no objection to the investor not applying the equity method, then the entity's debt or equity instruments are not traded in the public market. So it's not a listed company. Third, it is not in the process of getting listed. And the fourth is the ultimate or the intermediate parent of the entity produces CFS available for public use that comply with the international financial reporting standards. Same four conditions are given in IFRS 10 also. Okay. That is, it is a wholly owned subsidiary, parent does not object. If it is a partially owned subsidiary, the other NCI shareholders do not object. Not listed, not in the process of getting listed, and either its immediate parent or ultimate parent prepare CFS which are available for public use and which comply with IFRS. Then there are some more entities which are exempted from applying equity method. Exemption from applying equity method. When an investment is an associate or a joint venture. When an investment is an associate or a joint venture is held by or is held indirectly through. Held by these entities or held through these entities. An entity that is a venture capital organization. So investment in associate or joint venture held by or held indirectly through venture capital organization. Investment in associate or joint venture held by a mutual fund or is indirectly held through a mutual fund or unit trust and similar entities, including investment linked insurance funds. So many insurance fund has got investment link, like ULIP. What is that ULIP known as? Unit linked insurance plan. So it is an insurance also and it is an investment also. If you have made investment through this venture capital, mutual fund, unit trust, investment linked insurance fund, or if these investments are held directly by these funds, they are exempt from applying this equity method then in that case, which standard you will follow? You will follow IFRS 9. And what will be the classification of that investment? To get the exemption, you will follow FVTPL classification. The entity may elect to measure investment in those associates and joint ventures at fair value through profit or loss account in accordance with IFRS 9. So, investment by mutual fund, investment by venture capital organization, investment by unit trust, or investment linked insurance funds. If they have made investment in associate and joint venture, enjoy, don't apply. Subject to you follow FVTPL. Or if you have made through them, indirectly through them, then also exempt. When a portion of investment in an associate or joint venture, portion now, is held indirectly through venture capital organization or mutual fund or unit trust, that portion alone can be measured under IFRS 9. While the other portion directly held should be accounted in accordance with equity method. This is entity A. Through mutual fund, they have made investment in associate or joint venture. This portion will be exempt from equity method. Investment made by A Limited directly in the same joint venture, this you have to follow equity method. But this is not very important, trust me. It's only for scope paragraph. So if you have made through mutual fund, unit trust, venture capital organization, or investment linked insurance plans, those exemptions are available. Direct investment in associate and joint venture are not available. Now come to an important point where you will be asked a problem. Share of loss in associate. See this example I am going to write. You purchased investment for 50,000 cost, and then the associate suffers loss. So what you will do? You will calculate your share of loss. Suppose your share of loss is, associate loss is 1 lakh, your share is 20%, 20,000. Carrying amount, first year 30,000. Second year, again the associate suffered a loss. Share of loss. How much loss they suffered in the second year? Guess. 40 lakh. 4 lakh. Okay, 4 lakh. So 4 lakh into 20%. It comes to 80,000. Now tell me what will be carrying amount of investment in associate. 30,000 minus 80,000. 0. What is this mathematics? The standard says you are only an investor. What can you lose? What you have invested. What can you lose? What you have invested. Not beyond that. In general. Of course, we'll see some exception here. The investor's share of loss of an associate or joint venture is recognized. I recognized it here. Until it exceeds or equals. So now here it exceeds its interest in the associate or joint venture. Beyond that, no further losses are recognized, if any. So in a normal problem, if you are given this kind of question, you will show investment at nil value. After the investor's interest is reduced to 0, Again, suppose in the third year there is a loss. If in the third year also there is a loss, don't recognize the loss. After the investor interest is reduced to zero, additional losses are provided for. Now, when will you provide for additional loss? So, this exception you have to keep in mind. Additional losses are provided for and the liability is recognized only to the extent of investor has incurred legal or constructive obligation. So first is, suppose you have any legal or constructive obligation to pay for that loss. Like for example, you may have given a guarantee. Okay, or for example, there may be a partly paid investment. So in partly paid investment, according to the law, you may be required to pay the remaining amount. So additional losses will be recognized only to the extent investor has incurred legal or constructive obligation or made payment on behalf of the associate or joint venture. When you will solve the problem, this you will not assume. Okay, you will only write a note for this. In case if you get a negative figure, you will say the investment will be carried at nil value. However, additional loss can be provided if the investor has incurred, or additional losses only to the extent investor has incurred legal or constructive obligation or made payment on behalf of the associate or joint venture. What if the associate or joint venture subsequently starts making profit? Will you immediately start showing the positive balance? No. Now let us continue with that previous example. How much was the loss which we have not recognized? Let me check. 30 minus 80, 50,000. Okay. So 50,000 loss is not yet recognized. Suppose there is a turnaround in the fortune of the associate and they make profit of 20 lakh. They make profit of 20 lakh. Now the question they will ask in the exam, what will be the carrying amount of investment in the third year? So carrying amount of investment in the third year will be, what is our share I have taken? 20%. And how much is the profit? 20 lakh. So can you multiply 20% of 20 lakh? So I will show 4 lakh. Yes or no? Bolo? No. This 50,000 loss which is to be absorbed, first will be absorbed, and this year I am going to show 3.5 lakh. So this is what this paragraph says. On subsequent reporting of profit by the associate or joint venture, the share of profit of the investor will be first used to absorb the share of the profit of the investor will be first used to absorb the earlier unrecognized losses, and only after that the profits are to be recognized. Only after that profits are to be recognized. This is what you will do. So in case of problem of associate comes, like they may give you cost of the investment is 1 lakh. First year loss of the associate, first year loss 1 lakh. Second year loss, say 2 lakh. Third year they have given profit. Third year profit 20 lakh. And they may ask you, what will be the carrying amount of associate in each of the 3 years? So first year will be 1 lakh minus 20%, assuming our share is 20%. So 20% is how much? This I will make it 50,000 cost. So tell me fast, you are not answering. 20% of 1,20,000 loss. So my carrying amount will be 50,000 minus 20,000, 30,000. Next year there is a loss of 2 lakh into 20%, 40,000. My opening carrying amount is 30,000 minus 40,000 minus 10,000. No, nil. But remember 10,000 is unabsorbed. Next year there is a profit of 20 lakh. 20 lakh into 20%. 4 lakh minus 10,000. So third year my carrying amount will be 3 lakh 90,000. This way you will have to solve. Now on the screen there is a question. Pay attention. Big Limited has two subsidiaries, mini and small. In order to have significant influence over financial and operating policies, Big Limited acquired 22% control in Group Soft Limited. Total share capital is rupees 22 lakh. Okay, at a cost of 6 lakh. There was no accumulated profit or losses of Group Soft Limited on the date of such acquisition. During the next 2 years of operation, Group Soft Limited incurred total operating losses of rupees 30 lakh. Oh, show the investment in associate in the consolidated statement of Big Limited. One, after the acquisition of Group Soft Limited, and second, after 2 years of operations. So first we have to show the investment in CFS immediately after acquisition. Now this question was actually not required. Only what I'll do, I will check whether there is goodwill or gain on bargain purchase. Cost of acquisition is 6 lakh. Share in net asset. Haji, share in net assets. 20 lakh is the share capital and there is no other accumulated profit or loss. Your share is 22%. 22% of 20 lakh. Is it 4 lakh 40,000? So we are actually getting goodwill. 1 point. No further adjustment is required. So immediately after acquisition, I will write on the asset side, no, non-current asset. Then financial asset. Then investment in associate. Investment in which is the associate company, big or mini or small? Group Soft. So in Group Soft Limited, and then you will write amount Group Soft 6 lakh. Is the first part understandable? Second part. After 2 years, my cost of investment was 6 lakh. How much profit or loss they have suffered? 30 lakh. Your share is 22%. So tell me 30 lakh into 22%. 6 point. Balance in the outer column 0.6. Yes or no? No. Then nil. Okay. So apply the standard carefully. If your share of loss exceeds the cost or the carrying amount, investment will be shown at nil value. Additional losses will be provided to the extent investor has To the extent investor has suffered loss. Okay. So to the extent investor has incurred legal or constructive obligation or has made payment on behalf of the associate or joint venture. That note you will write as homework. Okay. Any query so far? Question number 7 is over. Now come to paragraph number 11. Paragraph number 11. Uniform accounting policies. Now, here there is a difference between IFRS 20, IAS 28 and Ind AS 28. One difference we have already noted. What is the difference between IAS 28 and Ind AS 28? First difference, in case of gain on bargain purchase, under this standard IAS 28 it is transferred to profit or loss, whereas under Ind AS 28 it is transferred to capital reserve. Next difference is uniform accounting policy. This standard says financial statement of the associate or joint venture shall be prepared using uniform accounting policy. Associate, joint venture, the investor and the venturer will follow the uniform accounting policy. Okay. Accordingly, if different accounting policies are applied for the like transaction and other events, then adjustments are made to reflect uniformity. Suppose the associate or joint venture follows different accounting policy, then what you will do? You will make adjustment to reflect uniformity. Then what is the difference between this standard and Ind AS 28? Ind AS 28 says, if it is not practicable to give the effect of difference in the accounting policy, then you can go ahead with difference. This standard does not give you the choice. India is a developing country. There are many small entities which may not be able to give the effect under Ind AS. So therefore, in that case, they have said that if it is not practicable, then you need not give the uniform accounting policy effect. IFRS does not give you any such option. It has to be same. And if it is different, make adjustments. Okay. Now, difference in reporting period. Can there be difference in the reporting period of the investor and associate, venturer and joint venture? Yes. What is the maximum difference allowed in the reporting period of the investor and the associate? Maximum period that can be allowed is 3 months. Why not more than 3 months they have allowed? Then the information becomes too old. Is it right? And in case if you have chosen 3 months difference, for example, then every reporting period, that gap should be consistent. What will you do with respect to those transactions which take place between the reporting date of the associate and the year ending date of the investor? Then in that case they are saying then make adjustment for significant events and transaction between the two dates. Okay, so such questions are usually not asked, but in case if they ask, so first you will take the associate's financial statement, give the effect of the adjustments given, plus minus adjustments. You arrive at the financial statement as on reporting date of investor or venturer, and then use this financial statement for applying this standard. Okay, yes or no? like they might give you some sale, purchase, sale of fixed asset, etc. transaction between these two dates. Whose year ending date should be first? Now there can be interpretation issue also. Suppose investor year ending date is 31st March 2021. 3 months can be on either side. 3 months can be 31st December 2020. 3 months can be 30th June 2021. Which financial statement will be used for applying IAS 28? The 3 months prior or 3 months ahead? Prior. Why not this one? Then you have to wait for 3 months first. Okay. Then they will prepare their financial statement. So it will be a too much of time consumption exercise, which means this company cannot finalize its CFS till 30th June, maybe after that only. So usually we will take the prior, the 3 months prior to your year ending date. One more important, very important tick mark, which I am going to use in the next 2-3 questions also. Treatment of unrealized intra-group profit related to associate. Now what do you mean by this paragraph? There may be transaction between investor and associate. Okay. Now there are two types of transactions they have mentioned. Downstream and upstream. This is downstream. But if the associate sells to investor, we will call it upstream. Does it make a difference in your treatment? The answer is yes. Under IAS 28, this makes a difference. Now, if it is downstream, means investor has sold to associate. Where is the inventory? Suppose it is not sold. It is with associate. The inventory is with associate. Okay. Do we consolidate this was upstream. Suppose I am talking about downstream. The stock is with associate. Do we consolidate the associate stock with the investor stock? The answer is no. Stock is with associate. Okay. Whereas in case of upstream, associate or JV sells to investor. Stock is with the investor. So keep this point in mind. Point number 1, we do not consolidate assets and liabilities of associates and joint venture with the investor. So therefore, if you have to eliminate the unrealized profit, in case of upstream transaction, where is the stock? With the investor. We are preparing CFS of the investor. Remove it from the inventory. But in downstream transaction, the stock is with associate. We cannot adjust in inventory. In case of downstream transaction, we cannot adjust in inventory. Okay. And therefore, we will adjust in the investment in associate or joint venture. So now a complete summary we have made at one place, which is printed in your book also. Downstream transaction, upstream transaction. If the sale of goods or asset at a profit is made by the investor to the associate, it is called downstream transaction, and the effect will be debit cost of sale in bracket, right? Consolidated P&L account. Consolidated P&L account. Suppose you are only preparing consolidated financial, consolidated balance sheet. You are not preparing consolidated P&L account. So only from the retained earning or consolidated profit given to you in the balance sheet, reduce the unrealized profit, and a corresponding effect will be given in investment in associate in the consolidated balance sheet. If you are preparing the detailed consolidated P&L account with revenue figure, cost of sale figure, administration figure, etc., then you make adjustment in the cost of sale. If you reduce the unrealized profit from the closing stock or the inventory, your cost of sale goes up. Okay. Being the elimination of group share in unrealized intra-group profits. And then the reason for adjusting in investment account is, in this case the URP is included in the associates inventory, but associate inventory is not shown in the investor financial statement as it does not consolidate the account of the associate. Hence URP needs to be eliminated from the investment and not from the inventory. Okay. And if it is an upstream transaction, sale of goods or asset is by associate, profit is made by associate. Entry for removal of unrealized profit will be debit cost of sale into bracket, write consolidated profit and loss or consolidated retained earning. Whatever you are preparing, according to that you reduce it. Okay. Now you are holding the inventory, so reduce the unrealized profit from inventory in the balance sheet, consolidated balance sheet. Rationale is, in this case the URP is included in the investor's inventory, which is included in the consolidated financial statement. Hence URP needs to be eliminated from inventory, with the corresponding effect will always go to either cost of sale or retained earning. Now we'll solve a question. Deferred tax also. Every item has a deferred tax adjustment. But if the question is silent in the exam, we will not do it. Now, dear student, please come to question number 8. H Limited holds 35% of the equity share capital of X Limited, which is classified as an associate of H. While preparing the CFS, the following information has been extracted. Stock of X includes goods of rupees 25,000 purchased from H. Who sold to whom? Stock of X includes goods of rupees 25,000 purchased from H, which sells goods at cost plus 25%. Just tell me, is it upstream or downstream? Downstream. Very good, 2 marks. Stock of H Limited includes goods of rupees 36,000 purchased from X, which sells goods at cost plus 20%. Find out the amount of unrealized profit to be eliminated from consolidated SOFP in respect of the above information. Also record the journal entries in the books of H. H is the investor, X is the associate. On the screen, you understand, first write down answer case A. Investor is H Limited, associate is X Limited. So the stock is with associate. The stock is with associate. Entry for elimination of profit, unrealized profit. So write down retained earning oblique cost of sales account debit. Calculate the amount. How will you calculate the amount? The profit is 25 upon 125 into 25,000. You will only eliminate your share. You will only eliminate your share, 35%. Is it 1750? Now, since the stock is with associate, I'm going to make adjustment in the investment in associate. Investment in associate X Limited 1750. Now write down below case B, upstream transaction. Now this time the diagram is like this. Associate to investor, stock is with investor. So therefore, we can remove it from inventory. So now you write the entry, retained earning account oblique cost of sale account debit, calculate 20 by 120. This is the profit ratio on sales. 20% of cost is 20 by 120 of sale into the amount of inventory 36,000 and then into proportionate stake. What is the proportionate stake in associate? 35%. Tell me, is the answer right? 2,100. Okay. Now one more question which is printed in cell practice. We'll discuss. Go to cell practice. In the previous lecture we have not taken problem on dividend. 23. Cell practice 23. Amar Limited acquires 40% share of Ram Limited on 1st April 20x1. The price paid is rupees 10 lakh. Ram Limited reported a profit of 2 lakh and paid a dividend of rupees 1 lakh. Pass unnecessary journal entries in the books of Amar. Okay. First entry for purchase of investment. Investment in associate account debit to cash 10 lakh. Is it right? Second entry for your share in the profit. Investment in associate account debit to share in profit from associate 80,000. And third entry, just check 80,000 is right. 2 lakh into 40%. Only your share. And third entry, you will receive how much dividend out of this 1 lakh? Your share is 40%. Cash account debit 40,000. To investment in associate account 40,000. Being dividend received reduced from carrying amount of investment. So this was one example on dividend. Now we will come to paragraph 15. Separate financial statement. An investment in associate or JV shall be accounted for in the entity's separate financial statement as per IAS 27. Already covered. Now next is impairment losses. Even in this standard, what you are doing, have you realized you are taking investment figure and doing plus minus something, okay? So over a period of time, the investment figure may keep on increasing. So one has to also check for impairment after application of equity method. So this is equity method. Just now you did plus minus. An entity applies IFRS 9 to determine whether it is necessary to recognize any additional impairment loss. Whether it is necessary to apply any additional impairment loss with respect to its net investment in the associate or joint venture. So for the purpose of calculating impairment loss, the impairment loss is calculated by reference to IAS 36. If impairment is indicated, the amount is calculated by reference to IAS 36. Okay. The entire carrying amount of the investment is tested for impairment as a single asset. This we discussed in the previous lecture also. Investment may include goodwill also, but goodwill is not tested for impairment separately. The entire investment will be tested for impairment, and then you will provide for impairment loss if any. The recoverable amount of an investment in an associate is assessed for each individual associate or joint venture unless associate or joint venture does not generate cash flow independently. So now you may have many associates, A1, A2, A3, A4. Okay. Ideally, what you have to do, each of them will be recoverable amount of each of this will be calculated individually. Just like in your IAS 36 we have done. Wherever possible, start with a single asset. Then if you can't calculate the recoverable amount, you go to the group which generates separate cash flow. Okay. So same logic they have applied, unless the associate or joint venture does not generate cash flow independently. Then in that case, we can take two or more associates together for calculating the recoverable amount. First recoverable amount, then impairment. Okay. If recoverable amount is less than carrying amount. Now next is, what is the place in the balance sheet where you will put this investment in associate or joint venture? It will appear as a non-current asset. Why? Because normally when we make investment in associate or joint venture, it is a strategic investment and the intention is to hold it for a long term. Although sometime the joint venture may be for a short period also. Okay. That used to happen in 11-12 standard accounts topic. Joint venture is a short term arrangement. But when you come to this level, it is not always 6 months, 8 months. If you have to construct a highway, and if it is a joint venture, it is not in 1 year, it takes many years. Okay. Sometimes joint venture runs for many years also. Like Hero Honda was a 25-year long joint venture. Okay. So joint ventures are just a mode of doing business which is not always very short term, as it is wrongly taught in 11-12 standard accounts batches. So, unless it is classified as held for sale. But if it is classified as held for sale, then which standard will apply? IFRS 5. Non-current asset held for sale. And then you will write a separate presentation in the financial statement. Below current asset, non-current asset held for sale. Next paragraph, discontinuation of equity method. When will you discontinue equity method? You apply equity method if you have an associate or a joint venture. That means you have either significant influence or joint control. So if you don't have significant influence or joint control anymore, then you will discontinue applying the equity method. Okay. For example, you may sell your entire interest. You may sell your entire interest means you have 20% share, you have sold 20%. Now you will not apply any standard actually. The difference between the following will be reported in the profit or loss. Proceed from disposal of interest in the associate or joint venture and carrying amount of the investment in associate or joint venture on the date of continuation of equity method. So for IAS 28 purpose, you will take the difference between carrying amount, sale proceed and sale proceed. And where will you transfer the difference on sale? Profit and loss account. Now, do you remember we had accumulated some amount in OCI also with respect to such associate or joint venture? If associate does revaluation of fixed asset, we record our share in that. If associate has some foreign exchange difference, we record our share in that. If associate has some other FVT OCI item, we have our share. So now what I'll do, those items which will be recycled to P&L account on disposal of this associate or joint venture, those items will also be recycled from OCI to P&L account. Is it right? So amount recognized in OCI in relation to investment of associate or joint venture shall be reclassified to profit or loss only to the extent that they will be reclassified on the disposal of such item in the entity's own OCI. Now example could be unrealized foreign exchange gain or loss. This you have learnt in IAS 21. If there is any unrealized exchange gain or loss and if it is accumulated in OCI, then on the disposal it is transferred to profit and loss account. While actuarial gain or loss is not reclassified to profit or loss. Then next is, if there is a retained interest in the associate or joint venture. So what is retained interest? Out of 20%, we sold 10%. Out of 20%, we have sold 10%. It means I am still holding other 10%, but that remaining 10% does not give me significant influence or joint control. So what I'll do, the asset should be measured at fair value of the retained interest. Is it right? So on the date of discontinuation of equity method, in case if you are holding some investment, you will value it at fair value with the resulting gain or loss recognized in the entity's profit or loss. Now there is one more possibility which actually we have applied in IFRS 10. An associate becoming a subsidiary. An associate or a joint venture becoming a subsidiary. That means sometime what happens, we are already holding 30% share in a company and it is my associate. I acquired another 30% share. 30 plus 30, 60. So do you remember what you have done? The previously held equity interest will also be fair valued. And then it will form part of consideration and will be used for calculating goodwill. Okay. If an investment becomes a subsidiary, then the fair value of the remaining investment in former associate, that means current subsidiary, shall form part of consideration. Okay. So this is a possibility that associate becomes a subsidiary. Apply IFRS 3. You have to measure the previously held equity interest at fair value. Okay. If an investment in associate becomes an investment in joint venture and vice versa, now very interesting, associate becomes joint venture, joint venture becomes associate, what will you do? Think, what will you do? Do you need to do any accounting adjustment? Because earlier also you were following equity method, now also you will follow equity method. Is it right? So therefore you will continue to carry the same amount without making any adjustment. Only while writing a note, maybe you can write that this is your joint venture now, earlier it was associate. Now in your notes there is one major change in Ind AS 28 versus IAS 28. So keep these two important differences in mind. One is that IAS 28 requires that for the purpose of applying equity method of accounting in the preparation of investors' financial statement, uniform accounting policies should be followed. In other words, if the associate accounting policies are different from those of the investor should change the financial statement of the associate by using the same accounting policy. So make adjustment. What is Ind AS 28? It says it has added the phrase unless impracticable to do so has been added in the relevant requirement. Second difference is carve out number 2. In IAS 28, capital reserve, when investor share in net asset exceed cost of investment, is recognized in profit or loss, while in Ind AS 28, paragraph 2 has been modified on the lines of Ind AS 103, business combination, to transfer excess of the investor's share of the net fair value of investee's identifiable assets and liability over the cost of the investment to capital reserve. Okay. So in IAS 28, gain on bargain purchase, P&L account. In Ind AS 28, gain on bargain purchase is transferred directly to equity. Directly to equity under the head capital reserve, not routed through profit or loss. Okay. Say yes. Yes. Now we will solve. First we'll solve one question number 11. Start with an easy problem. Question number 11. P Limited owns 80% of S and 40% of J. P owns 80% of S and 40% of A. J is a joint venture. 80, 40, 40, you understood? J is a joint venture and A is an associate. Doesn't make any difference. Treatment will be same. SOFP of 4 companies on 31st March 2019 are investment in SJA and then only one asset, PPE. Liability side, share capital of ₹1 each, equity share, retained earning, current liabilities. P Limited acquired shares in S many years ago when S retained earning was 520. P Limited acquired its shares in J at the beginning of the year when J's retained earning was 400. Now just pay attention on the screen. First about subsidiary. How much was the retained earning of subsidiary when the shares were acquired? 520. That is pre. Now in the balance sheet we have 3400 retained earning. So can you tell me how much is post? Very good, 2880. Same thing for J also. J total 3600. How much was on the date of acquisition? 400. So how much is post? 3200. A, pre, post, 400. This is also 400. So what is post? Same 3200. So we will not prepare a separate working note. This pre-acquisition will be adjusted for calculating goodwill. Is it right? Post acquisition of subsidiary, we will allocate between parent and NCI. Correct? But in case of this too, only we will calculate share of P Limited 40% and add it to the carrying amount of the investment. So how much is 40% of 3200? 1280. So what I'll do, 1280, I will add in the carrying amount of investment and I will also add in the consolidated profit and loss. That's it. Done. Now you can do as homework also. But there is an adjustment. The balance of goodwill relating to S Limited had been written off 3 years ago. So goodwill has already been written off. So whatever goodwill you will calculate, you will write it off by passing an entry retained earning account debit to whose goodwill? Only subsidiary. In case of other two companies, goodwill will not appear separately only. Question is prepare consolidated SOFP as per IFRS 10 as well as IAS 28. For S Limited, it is a subsidiary. IFRS 10 will apply. You will consolidate assets and liabilities. For this other two, IAS 28 will apply. Only carrying amount of investment would change. Okay, solve. Do you have the format? Right. First write down the name of the company. Consolidated balance sheet of P Limited as on. What is the date you will write? 31st March 19. Something you also have to do. Write the date at least. 31st March 2019. Okay. Then this is the SOFP format. This is consolidated statement of changes in equity format. Then this is your goodwill calculation format. Everybody is ready? Only this much is enough. And one more, sorry. Carrying amount of investment in associate and joint venture. You just have to add the share in post acquisition profit. So ready, steady, start. Property, plant and equipment. Will you add all the 4 companies or only first and second? Yes, do not add subsidiary, do not add J and A. So tell me total of 3200 plus 4100. Write yourself 7300. Then you come to investment in associate and investment in joint venture. Investment in subsidiary. So first you come to calculation of goodwill. Write down in subsidiary column 800. Correct? J column 600. 600. Wait a minute. Go to next working note also. Cost. Cost of associate 600. Cost of joint venture 600. Asset side is over so fast. Now you come to consolidated statement of changes in equity. First write down share capital opening balance, parent company only 1000. Then retained earning parent only. How much? 4,000. What about NCI? NCI. What is subsidiary share capital? 400. And what was the reserve on the date of acquisition? 520. So can I say NCI is 20% of, write in bracket 20% of, 20% you have understood? Share capital, write 400 plus what was retained earning? 520. So 400 plus 520, 920 into 20%. Anybody would like to volunteer? 180. So what is the total of this line? 151. Very good. 5184. 20% of share capital 400 and pre-acquisition reserve 520. Then we have to go to subsidiary share capital and retained earning on the screen. Subsidiary share capital 400 and pre-acquisition profit. How much is pre-acquisition profit, dear? 520. One more thing I have to write, NCI on the date of acquisition. 184. $984. Total of share capital and pre-acquisition profit is 920. So goodwill is 64. Are you getting 64? And how much you have to impair? Entire 64. So goodwill now left is 0. Goodwill left is 0. Agreed? So this goodwill that you have written off, can you also write here impairment of goodwill in the SOCIE? 64. Okay. Now wait a minute. I have to also complete JV and A just to check whether there is any gain on bargain purchase or not. Now here in case of JV and A, we will only write our share. We'll only write our share 40%. 40% of share capital 300. 40% of pre-acquisition profit. Pre-acquisition profit is 400. 160. Same thing in A also, 320 and 160 figures are same. So in both cases we are getting goodwill. Ignore. So 320 and 160 is 480. 480. So goodwill 120, 120. So no further adjustment required. So right here, note, no further adjustment required. Right below, afterwards you will forget. No further adjustment required. Now you come to next item in the balance sheet. Come to this working note, this consolidated statement of changes in equity. I have adjusted the pre-acquisition profit of subsidiary, joint venture and associate. Some amount is still pending, yes or no? So come to SOCIE. Subsidiaries post acquisition profit is how much? 2880 into 80%. 2304. Right here in bracket, write 80% of 2880. And in NCI column, write 20% of 2880. How much is that? 576. Write in bracket 20% of 2880. So total was 2880. Subsidiaries over associate. How much is associates post profit? 3600 minus 400 I have discussed. So 3200 into 40%. Haji, 1280. Try again. 3600 minus 400 into 40%. Is it 31280? Joint venture below. In retained earnings, same amount, same answer. Same amount, same answer. Now, these two figures on the screen, share in post-acquisition profit of associate and joint venture, will you also write in last working? Say yes or no. Yes. So write 1280, 1280. Tell me the total of this. 1880, 1880, 1880. Come to the main page. In main page, investment in associate 1880, investment in joint venture 1880. So in the process we have almost completed the answer. Only current liability we have not yet written. Will you add all four or only parent plus subsidiary? Parent plus subsidiary current liability total is how much? Write 500. Very good. So now we have completed the balance sheet. Read the adjustment given below. Is it over all adjustment? P acquired shares in S many years ago when S retained earning was 520. Done. P acquired shares in J at the beginning of the year when retained earning was 400. Done. P also acquired share in A on 1/4/18 when A's retained earning was 400. Done. The goodwill has been written off 3 years ago. Only you have to close. The share capital total is how much? 1000. Retained earning total? NCI total? 7. Last column total? 560. Okay. So transfer these three numbers to this main page. Share capital. Write share capital 1000. Other equity 8800. NCI was how much? 760. Is it right? Done. So what is the total now? 11060. 11060. Tallied. Any query? No. Okay. So in this question we have consolidated subsidiary, associate and joint venture, all of them. But there was no difference in the treatment for the associate and joint venture. Okay. Now we'll take a little more advanced version of this. Question number 12. Question number 12 is Air Limited, a listed company, entered into an expansion program on 1st October 2019. On that date, the company purchased from BAG Limited. There is another company called BAG. Its investment in two private limited companies. The purchase was of the entire share capital of Cold Limited, and second, 50% of the share capital of Dry Limited. So in Cold Limited, it is now a 100% subsidiary. So no NCI. 50% in Dry. Let us see the status of Dry. Both the investments were previously owned by BAG Limited. After acquisition by Air Limited, Dry Limited was to be run by Air and BAG as a jointly controlled entity. That means joint venture. So now we have one subsidiary and we have one joint venture. Both the investment done. Air Limited makes its financial statement up to 30th September each year. So what is the year ending date? 30th September. The terms of the acquisition were Cold Limited. The total consideration was based on PE ratio of 12 applied to the reported profit of rupees 20 lakh of Cold Limited for the year 30th September 2019. The consideration was settled by Air Limited issuing 8% debenture of rupees 140 lakh at par, and the balance by a new issue of one equity share based on market value of 2.50 each. Now you understand this one briefly. Consideration paid for Cold Limited. You can also write down immediately. Consideration paid for Cold Limited. Right hand side we will write rupees in 1000 because your given SOFP is also rupees in 1000. Okay. So first you understand the PE ratio. There is a valuation technique they have used. Earnings multiplied by P ratio. So how much is P ratio? 12. And how much is earning? Earning is 20. If it is 20 lakh, means 2 million. So in 1000 we'll write 2000. So what is the valuation of Cold Limited? 24,000. This is your consideration also, because you have acquired 100% share of this company. You have acquired 100%. So you have to pay 24,000, and it was paid in two forms. Debenture issued. Keep writing. How much is the value of debenture issued? 140 lakhs. 140 lakhs in rupees in 1000, 14,000. And point number E, right? Equity shares issued. Equity share issued for the balance amount is 10,000. 24,000 minus 14,000, C minus D. Okay, is it right? No. And what is the price at which equity share was issued? 2.50. So can you tell me 10,000 divided by 2.50, how many shares will be issued? $4,000. So you write down 4,000 means you're writing in 40 lakhs. Can I write like this? 40 lakhs shares at the rate of 2.5. This much you have noted somewhere in your notebook. This is the deal with Air Limited, between Air and what is that, Bag Limited, for acquiring 100% share of Cold Limited. If this is understandable, then we'll go to the next line. Cold is over, dry. This I am eliminating now from the screen. Now write down consideration for Dry Limited. For that, read next line. Dry Limited, we have acquired only 50%. Right hand side rupees in 1000. All figures will maintain in 1000. It says that market value of Dry Limited was 375 lakh. So point number A, market value of Dry Limited 37500. Then write down 50% thereof. We have acquired 50% of this amount. Tell me 18. Is it 18750? 18750. And how this is discharged, that also they have written. 75 lakh, issue of 75 lakh, equity shares at the rate of 2.50. Multiply 75 into 2.50, 187.50 in rupees in 1000. Is it matching? Next line is important. It says Air Limited has not underlined, not recorded in its book the acquisition of the above investment or the discharge of the consideration. So it means the given SOFP is before taking into account these two acquisitions. So what is the entry they should have passed? So you help me, what entry they should have passed? Investment in Cold Limited account debit 24,000. Investment in Dry Limited account debit, help me, 18750. To debentures account, 8% debenture account, how much? 14,000. Now wait a minute. To share capital and to securities premium, because you have issued shares at a premium. How many total shares they have issued? 11,500 into 1. And how many, what is the premium per share? 1.5. How much is that? 17,000. Just take this total. Is it matching? 42,750 total on both sides. So we will have to give the effect of this entry while preparing the SOFP. So my share capital tick mark below will change. Then securities premium will come, which is not there in the given problem. Debenture will come. And investment in Dry Limited will come, in the balance sheet plus any share in the post acquisition profit. And investment in coal will not come in the consolidated statement but will be required for calculation of goodwill. Is it right? Story is not over. The summarized statement of financial position of the three companies on 30th September 2020 are rupees in 1000, assets PPE, inventories, debtors, cash, liabilities, equity capital of rupees 1 each, retained earning, trade and other payable, overdraft, provision for taxes. The following information is relevant. The book value of the net asset of cold and dry on the date of acquisition were considered to be a reasonable approximation to their fair values. So you can take the book value as fair value. The current profit of cold and dry, this year's profit of cold and dry on for year ended 30th September 2020 is 80 lakh and 20 lakh. Is it right? Now 80 lakh is current year profit. So what is the pre-acquisition profit of cold? Any answer? In the balance sheet you will find 15,000 is the total profit. Out of that 80,000 is current year. So 7,000 is pre-acquisition profit. Same thing for dry also. For dry, in the SOFP 4500 and on for the current year the profit is how much? 2,000. So what is pre-acquisition profit? 2500. Is this right? So I will not prepare a pre-acquisition and post-acquisition working. This is understandable and directly will write at respective places. Next line, dry the joint venture is to be accounted using equity method. In any case, I am going to do that. Prepare SOFP as per IFRS 10 and IAS 28. So start line by line. 2 working notes you have prepared? Yes or no? Consideration paid for dry, consideration paid for cold. I hope you have written somewhere. Assuming you have written. Assuming you have written that journal entry also. Now we will start directly from the SOFP. Because the first 2-3 paragraphs I have explained and we have done the calculation also. So assets PPE. Do we have any adjustment in PPE? Say yes or no. No. Will you add air, cold, dry or only air plus cold? Yes. Only air plus cold. Do not add dry. Give me the amount. 34,260 plus 27,000. 61. Right here, 61,260. Okay. Then inventory. Come to inventory. Same. Air plus cold. Air plus cold. Can you tell me air plus cold is how much? 16,840. financial asset trade receivable 11,200 plus 5,060 16,260. Cash and cash equivalent 3,410. Next item, equity share capital. This will change, so don't write here. You come to the main page, consolidated statement of changes in equity. Opening balance, write down here, opening balance 10,000. Opening balance 10,000. And opening securities premium dash. Opening retained earning. How much is opening retained earning? 20,000. You can write 20,800. Yes, because the companies were acquired at the beginning of this year only. NCI is not there. So total is how much? 30,800. Then we come to issue of share. Issue of share, you have to write down the share capital figure. How much was share capital figure? Do you remember 11,500 in that journal entry? And securities premium? You have written securities premium 17,250. So total in the last column 28,750. Is it right? 28,750. So this is about share capital. 28,750 is right. And then I have to also credit debenture. So you come to debenture in the balance sheet. Debenture, how much was the debenture issued? How much was the debenture issued? 14,000. Write 14,000 here. Debenture issued in the problem, it is given 140 lakh, which is in 1,000, 14,000. So we have done equity, we have done retained earning. Wait. What about cold and dry share capital? Now, dear student, come to this calculation of goodwill. Consideration paid for S Limited total was how much? 20? Is it 24,000? Right here. And consideration paid for JV was how much? 18? Okay. Share capital of S Limited was how much? 20,000. And in case of JV, write half. In JV, write half. How much is half of 25,000? 12,500. Wait a minute. Then you go to this carrying amount of investment in JV. Right here, 18,750. Here also write down. Now we'll not. Next is retained earning. Retained earning 15,000 cold. Identify pre-acquisition profit out of 15,000. 8,000 is post. 7,000 write down. So 7,000 you write here and 8,000 you write here on the screen. Share in post acquisition profit of subsidiary. In retained earning 8,000, this is given. Wait. And what is subsidiaries dry limited pre-acquisition profit? Dry limited is 2,500 on the screen. Pre-acquisition profit 50% is how much? 50% of 2,500. 1,250. and post acquisition is 2000 into 100%, into 50%. On the screen, ACCIE joint venture, share in post acquisition profit of joint venture, 50% of 2000 is 1000. Is it right? Any query up to this? So retained earning is over. Up to retained earning, any query? And this 1000, wait, one more adjustment. Where will be the other effect of this 1000? I will add in carrying amount of investment, last working note on the screen. Add in carrying amount of investment. Is it 19750? Where will you transfer that 19750? No, balance sheet. Financial asset. Investment in JV. 19750 at the top, second line. Okay. Now what is pending? Current liabilities item. So come to trade and other payable. Add air plus cold. Anybody? Air plus cold. 22390. Write down yourself 22390. Only first two companies you will add. Do not add dry. Then overdraft. Only 1540. Short term provision for tax 5640 plus 2400 8040. Very good. Okay. Last item of balance sheet is over. So just see whether we have given all the effects. Share capital adjusted, securities premium adjusted, debenture adjusted, investment in cold, investment in dry also we have written. Goodwill calculation is pending. So come to this goodwill calculation. Can you tell me in the first column, do we have goodwill or GOBP? Gain on bargain purchase. GOBP. Amount 3000. Negative. And how much here? Positive. Ignore. No further treatment for goodwill. This is goodwill, right? But this 3000 is gain on bargain purchase. This what I'll do, I will add in the retained earning. Come to ACCIE on the screen, last line. Gain on bargain purchase. Amount? Is it 3000? 3000. Take column wise total first. Share capital. 21,500. $17,250. Retained earning total. Retained earning total. 32,800. Last column total. 71,550. Transfer in balance sheet. What is the total of securities premium and retained earning? 50050. These two. 21,500 share capital and 50050. So tell me, do we have goodwill in this answer? No. So goodwill write dash. What is the asset side total? 117520. Liability side 117. Tallied. Wow, amazing. Any query on this question? No query. Okay. Read now question number. Read question number 9 yourself. Okay, we'll come to one small question number 9. Harden acquired 8 lakh of Soldiers $1 equity share on 1st October 1998 for 2.5 million. This is the cost of acquisition of which company? Shoulder. 1 year later, on 1st October 1999, Harden acquired $2 lakh $1 equity share in Active for $8 lakh. These are the consideration paid. The fair value of the non-controlling interest is 7,50,000. The SOFP of the three companies on 30th September 2080 are shown below. Non-current asset, property, plant, equipment, patent, investment in shoulder, active and others. Current asset, inventory, trade receivable, bank. Total asset, equity and liabilities, share capital of $1 each, reserve, share premium, retained earning. Non-current liabilities, deferred tax, current liabilities, trade payable, taxation, overdraft. Now, the following information is relevant. The balance of retained earning of the three companies were HSA, 1st October 98. Now, which company was acquired on 1st October 98? Soldier. So, just tick mark Soldier's figure 1,200. That is relevant. And which company was acquired on 1st October 99? Active. Active 800 tick mark. That is pre-acquisition. 1200 is pre-acquisition of soldier, 800 is pre-acquisition of active. Any difference will treat it as post-acquisition. Other figures are not relevant. Okay. At the date of acquisition, the fair value of soldier's net asset were equal to book value, with the exception of a plot of land which had a fair value of $2 lakh in excess of its book value. Okay. So 2 lakh you tick mark plot of land, asset side, property, plant, equipment. This is fair value adjustment in pre-acquisition period. Next line, on 26 September 2000, Harden processed an invoice for $50,000 in respect of an agreed allocation of central overhead expenses to soldier. Now, normally in group company, what happens? Parent incurs expenses on behalf of soldier. How much expenses they have incurred? $50,000. At 30th September, soldier has not accounted for this transaction. Who has already accounted for this transaction? H has already accounted this transaction. Who has not accounted for this transaction? S, not yet accounted. So what entry S should pass? Expense account debit $50,000 to payable to Harden $50,000. This liability they should have provided, but they have not provided, which means I need to adjust their profit and loss figure by 50,000, will reduce it, and then this payable 50,000 entry they will have to pass. Now you see one important line. Soldier has not accounted for this transaction. Prior to this, the current account between the two companies had agreed at soldier owing 70,000. H S. In the books of S, amount payable to parent company 70,000. And in the books of H, amount receivable from soldier 70. But H has already passed the entry. Now H will be showing plus 50. H has passed the entry. Listen to me. Amount receivable from S account debit to expense. They have transferred their share of expense, which means in the given question, the debtor from subsidiary is 120, payable to parent company is 70, will cancel these two figure, and the difference 50 will treat it as expense and tick mark retained earning. After passing this entry, the two balances will become equal. This will also become 50 and this will tally, but this expense we have to adjust in retained earning of the soldier company. Next paragraph. During the year, Active sold goods to Harden. Active means associate, Harden means investor, at a selling price of $140,000, which gave Active a profit of 40% on cost. Harden had half of these goods in the inventory. So first we'll calculate the unrealized profit and then multiply by Harden's share in Active share capital. Can you tell me what is the stake of Harden in Active in percentage term? Harden is holding 2 lakh share. Active has issued 5 lakh share. So 2 lakh by 5 lakh. Is it 40%? 40%. This is called URP on stock. URP on stock. Half of the stock is unsold. Anybody who can give me the correct answer? How much is unrealized profit on stock? 8. What is the journal entry will pass for this? Consolidated P&L account debit 8 to inventory or investment. Who has sold to whom? Active to Harden upstream. Where is the inventory? With Harden. Whose CFS we are preparing? Harden. So is it not in the inventory of Harden? So don't you think we should adjust the inventory? Because we are carrying that inventory which includes this profit. Okay. Prepare consolidated SOFP. So can we start now? Say yes. Yes. So dear student, this is a very easy problem. Do not add active figures. One general instruction for all of you. Property, plant, equipment. Take 3980 plus 2300 and plus one more adjustment. 2300 and one increase in the fair value of that asset 200. So can you give me the total of this property? This 200 is fair value adjustment 6480. Now you have become champion of all such things. Is it right? Now where is the second effect of this 200? This you will write in there is one analysis of profit working we have prepared, pre and post. Keep first few lines blank and then write fair value adjustment. In pre column write 200. In pre column write 200. Revaluation of asset, write down in bracket. Revaluation of land. In bracket write revaluation of land. Okay, now come back to the question. You have patent. In the question, patent. Do we have any adjustment in patent? No. 250, write yourself 250 plus 420. Total 670. Then investment in soldier and active. This we will write in this goodwill calculation. Consideration paid. Soldier 2500, right? Active. How much is active? 800. Okay, wait. And this cost of acquisition of active, you also write in carrying amount of investment in associate. Cost 800. This you will write at two places. 800. And what about other investment? Will they continue to appear in the balance sheet? Other investment, say yes or no. I have written here other investment. So kindly tell me total of 150 plus 200. 350. Do not add active. Okay. Then current asset inventory. For the time being, you just write 570 plus 400. Adjustment later. Trade receivable 420 plus 400. Plus 380. 380. In the other company it is 380. Adjustment later. cash and cash equivalent 0 plus 150. 150. 0 plus 150 is 150. 150 is there. Okay, come to equity share capital. Parent company share capital, write 2000. In the outer column, share capital 2000. Also come to the statement of change in equity. Share capital parent, write 2000. And share premium parent, write 1000. Retained earning parent 4500. Now read the first 2-3 lines when the problem starts. NCI opening balance is given 750. Tell me the total of this line. 82. Sure. And where will be the second effect of that NCI? Yes. In that calculation of goodwill, NCI in first column, right? How much you said? Very good. Write 750 dash. Tell me the total here. 800. Fair value of identifiable net asset. Share capital of subsidiary is how much? Write full. And share capital of active, write 40% only. How much is 40%? 200. Pre-acquisition profit will not write now. For that you come to this working, analysis of profit. In analysis of profit you write retained earning. Pre-acquisition you will find in a small table. Shoulder you write 1200 and active you write 800. Is there anything more? Share premium. Do we have share premium in subsidiaries books also? How much is share premium of these two companies? Right, first column. 500 and 100. Now wait. In the balance sheet, retained earning is 1900. But you have written retained earning 1200. So 700 will belong to post column, correct? Similarly in active, 1200 minus 800. $400 will go to post column. Don't take total, wait. Some more adjustments are coming up. Any query up to retained earning in the balance sheet? No. Deferred tax back to balance sheet. Only one company's deferred tax you will write. Which company's? Parent. How much is that? 200. Then you come to current liabilities, trade payable. Trade payable, write 750 plus 450, but don't take total, one adjustment is coming up. Then I have written borrowing overdraft. Overdraft is 80 in the outer column directly. Okay. And taxation 140 plus 0. Is it 140? 140 plus 0. Do not look at active column. All items in balance sheet we have done. Pre and post acquisition profit also you have written. Then at the date of acquisition, the fair value of soldiers' net asset were equal to their book value, with the exception of a plot of land that had a fair value of $2 lakh in excess of its book value. This also we have done. On 30th September, 26th September, Hardin processed an invoice for $50,000 in respect of an agreed allocation of central overhead expense to soldier. Who has to bear these expenses? Soldier. Who has initially paid? Hardin. Now Hardin wants to recover it from soldier. Hardin has already passed the entry. Soldier account debit to expense account. So no adjustment in the books of Hardin. Soldier has to pass the entry. Expense account debit to amount payable to Hardin. So if they pass the entry for expense payable on the screen, what will happen? Their post acquisition profit will be reduced. So write down less overhead expense. 50,000, 50. We are writing in 1000. Okay. Now come to balance sheet. In balance sheet, from trade payable, how much amount you will remove? 70 or 120? If you want to remove 120, first you will have to add 50. So plus 50 and minus 120. First you have to pass entry for payable and then remove it. So can you give me the figure of trade payable in the outer column? Expense recognized 50 and 120 intercompany dues. Intercompany dues 1 and then you come to asset side also. From trade receivable, how much will you eliminate? 120. 120. They have already passed the entry. Only directly write minus 120. Whereas in the books of the Hardin, first I have to record the expense and then eliminate 120. How much is trade receivable in the outer column? Add on your calculator carefully. 420 plus 380 minus 120. Anybody? 420, 380 minus 120. Haji, you. 680. 680, right? 680. One adjustment is pending. Inventory. Okay. What is given about inventory? During the year, active sold goods to Hardin. Who has sold? Active. So it is associate to investor, upstream transaction. To remove the unrealized profit, we will take entry retained earning account debit to inventory account. On the screen, consolidated statement of change in equity, unrealized profit on stock. So you write like this: 1,40,000. This is the inventory amount into 40 by 140. This is profit margin into 1 by 2. Half of the stock is unsold into 40% into 40%. So how much it comes to? 8. We have already calculated earlier also. 8 in bracket. Total column 8 in bracket. And the second effect of this You have to visualize where it will go. It will go in inventory because parent company is holding that inventory which it has received from active. So now 570 plus 400 minus 8, 962. Are you getting 962? Say yes. Yes. So all adjustment I have done. Dear student, please take out your calculator and tell me the total of all this pre-post column. Shoulder pre-column total 1700. Post column total 650. Active pre-column 900 and post column 400. $1,900. Okay, pre is 1900. Make it 1900. And then in post figure of shoulder, we have to divide between Harden and NCI. What is their profit sharing ratio? 80%. What is their stake? 80 and 20. So dear student, tell me 80, 20 in post column. 521. Wait a minute. And in the 40% in the active also tell me pre and post. 40% only. 40%. Pre also tell me. Is it 360? Yes. This 1900 and this 360 we will use for goodwill calculation. Okay. 1900 and 360 on the screen. 1900, 360. Total of these two figures 2900, 560, goodwill 350, and second column 240. Since it is goodwill, no further treatment. And where will you transfer this 350? Only this 350 subsidiary you transfer to SOFP. Transfer to SOFP. 240 no further treatment. So come to this balance sheet. Goodwill write down 350. Answer is not over. Wait a minute. Now you come to the last working note. Carrying amount of investment in associate. Add share in post acquisition profit. How much was post acquisition profit? Is it 160? 160 you will find in the other working note. 960. 160 is there. 160 is there. Now you come to main page. Investment in associate. Write down in the outer column 160. Investment in associate, outer column 160. One last thing. Come to SOCIE and come to this line. Share in post acquisition profit of subsidiary. Retained earning column. how much was the share of parent company in subsidiaries post retained earning? Anybody? You can write these two numbers, 520 and 130. Okay, 520, 130, 650, and in associate 160. 160. Now you tell me total. 2000, 1000. Then how much is this? 5172. This is how much? 88. Last column. 9052. Okay. Stop. Huh? What is the total of these two? 6172. So now I will write share capital 2000, other equity 6172. NCI total was how much? 880. Is NCI 880? Now you are ready to take the total of asset side and liability side. Asset side total. Asset side total. Take 6480 plus 350 plus 670 plus associate 960 plus 350 plus 962 plus 680 plus 150. 10602. Okay. And then you come to liability side. How much is the total? 10602. This answer is over. Now we'll continue tomorrow.